Hey, so today I'm doing another valuation video and I'm doing SDI Group. So I've had a lot of requests for this one over the last few months and I'm finally getting around to making it. So I hope you enjoy this, and a Merry Christmas for everybody. If you do enjoy this on your holidays, please give it a like and leave a comment and share it with somebody who also likes SDI Group. So yeah, let's just jump in. So SDI Group is another of the serial acquirers that I've been researching and spent a lot of time trying to understand. They're predominantly in the scientific instruments game, based out of the UK. An example would be Opus Instruments, which is one of the subsidiaries that make infrared reflectography cameras for the use in art conservation within the UK National Galleries. Now, this might sound like a really specific niche to be in, and it is, and I like that because like someone like Apple or Nvidia aren't going to jump into the infrared reflectography game anytime soon. These niche markets are just too small for the big players to worry about, and SDI Group over many years now, over a decade, have built some really good relationships in this weird scientific instruments community. And what I think is important is that all the subsidiaries generate good cash flow and they have stable businesses and loyal customers. And I do like serial acquirers because if done conservatively, I think that they can be a great low risk investment, but still capture the high upside that I want in an investment. So SDI Group are acquiring businesses at somewhere around 5, maybe at the max end 7 times EBITDA. And these businesses come with a little bit of organic growth as well. So that's something they're trying to keep that growing, that organic growth part, but they're getting the return just from buying them at 5 to 7 times. So that turns into say 20, even 30% return on invested capital. Now you can probably hear cockatoos in the background. I'm in Brisbane, Australia. There is just so many cockatoos here. I apologize for that noise, but that's what that squawking noise is in the background. Anyway, I digress. Let me get back to SDI Group. So they have extremely low head office costs, and they're reinvesting all of their free cash flow back into more organic growth into the subsidiaries, and then more acquisitions. And this turns the business into a compounding machine. Now, I think the serial acquirer model sometimes gets looked down upon as they're either destroying capital or it doesn't work, or they all can't be so good and amazing like the ones that are all in Sweden, for example. But I think it just really comes down to management and also being specifically involved in a particular niche. Or in the case of someone like Technion, you have a really interesting sort of unique way of sourcing deal flow, and that can be your competitive advantage. So I think it comes down to management, and with Mike Creedon leading SDI Group, I think they're onto something by staying inside the scientific instruments niche. Yes, there's Judges Scientific as well that are doing a really good job, but I think there's room for both. And from a management perspective, you have to be really diligent with the shares outstanding, the leverage that you use, and the diversification of the subsidiaries as well. And I believe that SDI Group has all these things in place. Now, in the past, they had been issuing shares, but I think they've passed that inflection point. Well, I've also talked to Mike about this, and he thinks they've passed this inflection point where young serial acquirer businesses, they need to raise money and issue stock to go out and get those acquisitions in the early days. And that's how they fund the acquisitions. But once they get past that point where they have enough cash flow generated from the acquisitions, they can just use the free cash flow and some debt to go out and buy more. And SDI Group have just reached that point, which they detail in their slides, in their presentations, which I think is really cool. And I think by getting to this point, it actually reduces a lot of the risk in investing in a serial acquirer. So yes, you can get in really early days, but you don't know how they're going to handle the share count and all the debt and all the things that happen to get that snowball moving. But once it sort of builds up some steam, I think then it becomes really safe. And this is definitely not a no-brainer at all. There's a lot of moving parts here, and management execution is really critical moving forward as well. I learned so much from going to see Johan and Daniel at Technion on how to do this the right way. And I see Mike Creedon at SDI Group doing it almost the same, and that's why I've gone into SDI Group personally. And about Mike Creedon, he's the CEO. He's been in the business for over a decade now. I think he's a really great CEO. He talks really straight. He's really honest. Doesn't hide anything. Seems really down to earth. I really enjoy chatting with him. I feel like he's somebody that is very motivated to keep this moving forward. And the issue that comes up is that he doesn't have a lot of stock ownership in SDI Group, and that can be maybe a concern regarding incentives, and maybe he's going to leave at some point or something like that. After talking to him, I feel like there's no chance that's happening anytime soon. Of course, one day he'll retire, and because he'll be getting old. That's, I think, still 5-10 years away. But that is some concern because we have key man risk with him. Something to keep an eye out for, and something to monitor on this investment as well, is who will be next in line. But if you want to see how much he loves the business, I've interviewed Mike here on the channel. You can go back and watch that episode and you'll get to know him a lot better. And it's also not like Mike doesn't have some skin in the game. He actually has accrued a lot of long-term options and some shares as well, as he's gone over, as it being the CEO over the last 10 years. So in relationship to his net wealth, he actually has a really big chunk of money there. It just doesn't seem like a lot considering the size of the business and how much money, these options he actually has. But by looking at the remuneration report, his options are well into the millions of dollars now, and this is quite a significant nest egg. And I'm confident he has skin in the game. And I also think it's just his baby, because he's gone through all the tough times and built this thing through the dark days and from the ground up in those days of issuing stock and trying to accumulate these subsidiaries to a point where it's now stable. I don't see a reason why he would want to jump ship anytime soon. He's kind of, the good times are just getting going for this business, I think. But of course, it's not perfect. I'd love to see him with a 20% stake in the business or something like that, like a lot of my other investments. But I have to just get on board with the idea that I think his incentives and his heart's in the right place here, and that's what I'm going to go with. So now let's talk growth. So as you can see with the revenue numbers here since 2016, it's looking like a pretty nice hockey stick curve here, but I'll explain this a little bit in a moment, but you can see the same with adjusting operating profit, cash generated from operations as well, looks really good. We've got here the revenues, the 2021-2022 growth is like 40 to 70%. Cash generated for operations is 25% growth. These numbers in the last 2016 to 2020, what's that, 6 years? That's exceptional numbers, from 32% adjusted earnings per share, cash generated growing at 50% compound annual growth rate. These are some serious numbers of growth here, and this is something that, firstly, we obviously should get excited about, but I'll explain this a little bit in a moment why we have to temper our expectations. Now, page 7, I think, is a really cool slide where they're talking about the acquisition strategy, the buy and build strategy. So you can see that each year they've been able to employ, spend more capital, and that the return on the capital employed has been growing as well over that period of time. It's really starting to snowball really nicely here. But 2022 and 2021 are quite exceptional years. But they've been able to get more acquisitions in this time as well. So this is a really good example of a compounding business here. Now we move over to page 8, which I think is kind of what I was explaining earlier about how they don't need to hopefully issue more stock. So buy and build model started in 2014 with acquisitions largely funded through equity raises. That's issuing shares. But the last equity raise was in 2019, in February 2019. And free cash flow has been the primary source of acquisitions funding since 2018. So the borrowing capacity has also increased in line with the free cash flow growth. So essentially they've been able to access more debt because their free cash flow is getting stronger. Now they don't need to issue any more stock to get these acquisitions because the free cash flow and the debt is combining to do that. And this is what I mean by it's got to this inflection point. And I think this is really important for the safety of this business, because if we don't want to see stock getting diluted, because if the stock price gets punished at any stage, a lot of the acquisition strategy is going to slow down, because companies out there, like private companies, they're not going to want to take stock in a company that's declined 70, 80% in their stock price or something like that. They might be thinking, well, if I'm going to get stock for this, I don't want the stock. I want just the cash. And because the markets are so volatile, we never know what's going to happen. So you've got to get away from issuing stock to make acquisitions, I believe. So free cash flow plus debt is, I think, the right way to get there. Hard in the early days, but now they've got this this is what gets me excited. So I do think that SDI Group have all the things that I'm looking for in an investment. They have a smart, experienced, high integrity CEO that has a long-term mindset. They have a long runway to compound further. They have very good growth and reinvestment rates. Okay, it's really important now that I highlight some of the risks. So let's go through those now. So the first risk is bad acquisitions moving forward. So deals that look good at the time, but don't deliver as expected. This will hurt the return on invested capital and the growth of the business. It will be value destructive. This is a key risk. This is why we need a good management team. Now, to monitor this, we want to see revenue of each subsidiary growing or at least stable. And not every year is going to be okay because there are obviously macro factors that can interfere, but an overall stable revenue and earnings from the acquisitions is something to watch for. Then there's increased competition to the subsidiaries, of course. So this is obviously a risk for all the businesses. It is why I like to see a diverse group of businesses, and at least more than 5 or 6 anyway, because it reduces the exposure to something bad happening in one particular niche. And the third big risk, I think, is staffing, specifically around Mike or anyone in management. If something happens to them, or essentially anyone who's leading one of those subsidiaries, like the boss of those places, because finding good people is just really hard, as we all know. And finding a toxic person that erodes the culture can actually be far worse. So good hiring is always going to be important, and good hiring is really difficult. Now, these 3 risks I actually think apply to pretty much all the serial acquirers and actually apply to lots of businesses in general. So they're pretty standard risks here. We're not going to put our entire portfolio into something like this anyway, but just be aware of those risks, I think is good to know. Now, if we were just to have a look at the current growth rate of, say, 25% plus at the moment, right? Let's say it's been somewhere between 25 and 50% growth, but we could pay a PE of somewhere in that range to get a good deal. That would be a PEG ratio. And right now the PE is 20, but look, I think that might be just too aggressive from a growth rate perspective. Expecting 25 to 50% ongoing 10 years from now is hard to believe. Mike says it's actually been a really good year, and the expectation is that 2022-23 is probably going to be flat on this year. So they might not have any growth in the next 12 to 18, 24 months. The reason behind all that is they got quite a big boost from COVID, everyone needing to buy a lot of scientific measuring equipment because they needed to test for new diseases in scientific labs, and universities needed a lot more stuff. It was a bit of a push from a bit of a COVID push. They're not going to get that in the next year. So definitely thinking it's going to be flat. Some of their subsidiaries will have some organic growth. Some of them will have some declines, but overall for the group, if they can stay flat, I actually think that's a good situation. Now that's regarding the organic growth, but if we're talking about, well, then they're going to still add on some acquisitions, and that's what Mike has been actively looking for, and looking like he's going to be able to get some more of those. So at buying them at 4, 5, 6 times EBITDA, we're all of a sudden getting 15% growth rates just from inorganically from the acquisitions. So what I've tried to do is try to think about this from a conservative point of view. Maybe the next year or two is flat. The acquisitions get it closer to 15%, let's say. I don't know. Macro stuff. There's a lot of variables here in this growth rate. So I'm just going to say 12% and then 15% moving forward. Oh, remember, this has been growing for the last 6 years at 25 to 50%. So that's quite a slowdown, and I think that's okay. I've got my discount rate in there where I'm chasing 15%, but I've got a margin of safety. The margin I could sell it for in 10 years' time, which is, there's no multiple expansion in this. It's about what I'm paying right now. Then I've got the free cash flow there, the shares outstanding, total debt. It tells me I want to buy this at $1.57. It's actually £1.57. It's essentially what the price is today, which is saying to me that this is a good price right now for a great company at least a fair price, if not a good price. Then I look at just a 5-year model, like an earnings per share kind of multiple. I actually used, it says free cash flow here in the column, in column A, in that first column, but just ignore that. I'm actually looking at earnings per share, I think, when I did this. So I've got the current revenue, their revenue growth rate, I've put up to 20% just to get a feel, because I think maybe 15% was a little bit on the conservative side. Got the margins in there that they've been consistently being able to do. And I think I've pulled it back a little bit. I've got a feeling it was 15%. I've pulled it down a little bit to 13. Macro factors, etc. Blah, blah, blah. Dilution rate, free cash flow multiple, that's an earnings per share multiple, it should be current market cap. And it tells me that I should be expecting around about 15% compound annual growth rate in the share price from here, all things being equal. This is all just ballpark numbers. Please don't get too wrapped up in the specifics of this. This is for me just getting a feel for where this thing is, whether it's super overvalued or super undervalued. I think it's probably fair price at the moment, and that's pretty good. So for those who watched my previous video on Technion, just like Technion, these guys are, I guess, around a fair price. I'm not getting a bargain or anything but like that, but then it comes down to how good this company is, and paying a fair price might be totally cool. So for this to work out, essentially Mike has to be able to continually find acquisitions, which he's pretty confident that he has an acquisition pipeline in front of him, that he can continue doing this. The subsidiaries need to continue operating as normal. Macro factors are going to come and go a little bit. It's going to be a little bit up and down, of course, but I think over a decade, the runways in front of them to just continually work and grow into that. This seems pretty attractive to me. But just remember those risks I talked about earlier, because they're really important with any business, and that's what you've got to get through. And I think staffing actually is a really important thing, especially in subsidiaries. I think that's how serial acquirers will come unstuck, is if they find it really difficult to replace the people running the subsidiaries. Because look, that's especially in scientific equipment like SDI Group, those people are going to have like so much experience and such specific knowledge that replacing somebody with like someone who knows about infrared cameras, for example, and can be a good leader of an organization, like that's such a unique person to find, that's where the risk is in my eyes, is replacing people. Now remember, SDI Group is a UK-based company. I can buy these on Interactive Brokers, which is the broker of choice for me. That's what I did. And in the link in the description, you can get a demo account, take it for a spin, see if you like it. I think it's really important to get a good broker. We've all just learned about FTX and how giving your money to somebody where you think you're investing in Bitcoin, but the real risk is the person holding that money and making that exchange for you, which is the broker. That's so important to an investment. So please do your due diligence on your broker. If you're looking for one, Interactive Brokers, I think, is the pick, because they're a public company. They've been around for multiple decades. They've gone through financial crises. They're not a startup like Robinhood or anything like that. Anyway, that's why I'm an Interactive Brokers person. Now, if you haven't been following my channel, which is apparently about 20% of you, the things that I'm looking for in an investment that I'd be very happy if you shared with me are things like a company that has a lot of growth and high internal rates of return, companies that have a long runway in front of them. So they're probably going to have to be a smallish cap company. And I think most importantly, they have to have just great leadership with high integrity, hopefully some skin in the game as well. But that's got to be the key part here. Like, sell me on how amazing the management is first, and the growth rates and all that other stuff is what I need to see as well. But sell me on the management first, please. Give me a bit of a summary. Don't just say, oh, please look at this stock, because I'm not going to, unless you give me a bit of an elevator pitch and tell me why I should look into the stock. But I'll try to give you some feedback if you do. Let me know what stock you think fit those criteria. And if you do want to discuss something like this further, there's a link to the Discord group in the description. We're playing a game in there at the moment, but that Discord group is where you can also contact me and we can talk about your idea and things like that too. And yeah, I hope you've enjoyed this video, and yeah, I will see you next week.